Here's an uncomfortable truth. Most investors are trapped in a cycle of repeating the same costly mistakes. We make a poor decision, suffer the consequences, then do exactly the same thing again. Research shows this affects everyone from wealthy individuals to fund managers. According to investment strategist Joachim Klement, there's a simple reason why it happens.
The thing that we don't learn is we really have, typically as investors, no process in place to learn from our past investment mistakes. And that remarkably is true for both retail investors, common day, everyday investors, and investment professionals. We're constantly kind of making investment decisions. And by the way, not making a decision is also a decision. And we're never going back to check were these decisions really the right ones. We just kind of move on to the next problem.
So what's the solution? Well, one idea you might find helpful is to keep an investment diary, a record of what you do and why.
Something that I recommend investors do is have an investment diary. I have one myself. It's a pretty boring one because it says on the first of the year, kept my portfolio unchanged according to my financial plan. And then a year later, I go back, it's like, good decision. If you are a bit more active or if you do something, write down what you did and then three bullet points. First bullet point, what you did. Second bullet point, why you think it should work out and why. And third bullet point, what is the risk and how could it go wrong?
The investment diary approach certainly worked for Joachim Klement. He thought he was good at timing markets. His diary revealed otherwise.
I'm German, we're always naturally pessimistic. And I was always really good at selling before markets went down, before I lost money. That's really what I remember. I was really good, especially before the financial crisis. I reduced my risky assets significantly in 2007. Well done. What I tended to forget and ignore until I started doing investment diaries is that I was completely rubbish at getting back in. So what happened in the financial crisis, I reduced my risky assets in 2007, but I didn't really get back into the market until 2010. And the end result is it was effectively a wash.
Even if you do keep an investment diary, though, that doesn't make you immune to making mistakes. The key is to learn from your mistakes so you don't repeat them.
If you want to have an advantage over other people, it is by getting to know yourself better, and improving, constant learning. What it will help you do is eradicate one mistake after another.
So by recording your investment decisions and reviewing them annually, you'll recognize your behavioral patterns. You might discover your supposed strengths or weaknesses in disguise, or vice versa. Either way, the process takes minutes, but it could save years of regret.